All right, welcome back everyone. We are officially on day 8 of our 30-day options trading explainer, and I am genuinely so excited you're here. Why? Because today we're tackling literally one of the most fundamental concepts you'll ever need to survive in the market. So if you recall, back in day 7, we spent a lot of time on the positioning of options, right? We talked about in the money, at the money, and out of the money. Now that was all about location. But today? Well, today we're shifting gears to something arguably way more important for your wallet. We're looking at the actual price you pay. You know, if you've ever opened up your trading app and just stared at an options chain, you've probably asked yourself this exact question. I mean, why on earth does one option cost 20 rupees while another one sitting right next to it costs 200 rupees? Like, what's the difference? What exactly are you paying for when you finally click that buy button? It's honestly a huge mystery for so many absolute beginners. But the answer to this question is actually the very heartbeat of options trading. And the whole thing boils down to just one single word: premium.
Okay, let's dive right into this. The premium is, well, quite simply the actual price you pay to buy an option. That's it. Whenever you buy an option and money actually leaves your account, that money you're handing over, that's the premium. A really great simple way to think about it is as your cost of opportunity. Basically, you're paying to take a chance in the market. You are buying an opportunity for future profit. And the premium, it's just your entry ticket to that specific opportunity.
Let's put this into everyday terms to make it super clear. Imagine you walk into a store to buy a brand new smartphone. You pay money, and in exchange, you get to own that physical phone, right? Very simple. Well, buying an option uses the exact same logic. You're still paying money, but instead of walking out of a store with a physical phone in your hand, you're paying a premium to get the right to the option contract. You pay money to get those rights. And that money, the cash you hand over, is the premium.
Moving right along to section 1, calculating your total cost. Let's look at exactly how to calculate it.
Now, I know math can sometimes feel a bit intimidating, especially for absolute beginners in finance, but figuring out exactly how much money is actually leaving your account is incredibly simple. It's really just basic multiplication. Let's walk through a real-life scenario together. Let's say our underlying asset is the Nifty 50, and it's currently sitting right at 20,000. You decide, hey, I want to buy a call option on this. So you check the market, and the call option premium is listed at 100 rupees. Now here is an absolutely vital piece of the puzzle. Options are sold in batches, and we call these batches lot sizes. For the Nifty 50, the lot size happens to be 50. You literally cannot buy just one single option, you have to buy a whole lot of 50. So, to figure out your total cost, you just multiply the premium by the lot size. 100 rupees multiplied by 50 gives us 5,000 rupees. Boom! That's it. That 5,000 rupees is the total premium you're going to pay to enter this trade. It's the maximum amount of money you are putting at risk to buy this specific opportunity. Always remember to multiply your premium by the lot size so you understand your true financial commitment before you trade.
All right, let's shift gears to section 2. Why do premiums change? Okay, so if you just sit and watch a premium of 100 rupees for, say, a few minutes, you're going to quickly notice something. It doesn't actually stay at 100 rupees. It flickers. It goes up to 105, then it dips down to 98. Premium just keeps changing continuously. Just like the price of a regular stock goes up and down all day long, option premiums are constantly on the move. And this changing price essentially boils down to 3 key factors. First, market movement. If the underlying stock or index is moving wildly, well, the premium's going to react to that. Second, time left to expiry. Options have a ticking clock, and that ticking heavily impacts their price. And third, basic demand and supply. It's just a matter of how many people want to buy versus how many want to sell. Now please, don't sweat it if this feels a little advanced right now. We're actually going to be learning how all of these specific mechanisms work step by step later in this series. For today, just understand that premiums are always moving.
And that brings us to section 3, 3 common beginner mistakes. Let's quickly go over what you definitely want to avoid. So, because options trading is so accessible these days, it's really easy to fall into a few traps when you first start looking at these premiums. Keep these 3 crucial warnings in mind to protect your capital. Mistake number 1, buying options just because the premium looks cheap. A 5 rupee premium might look like a total bargain, but listen, in options, things are usually cheap for a reason. Usually, it's because the chance of that option actually making you money is incredibly low. Mistake number 2, not calculating your total cost. Remember our formula? If you forget to multiply by the lot size, you might think a trade only costs 100 rupees when it actually costs 5,000. Trust me, that is a very fast way to blow up your account. And finally, mistake number 3, ignoring time decay. Like we just mentioned, options have a ticking clock. Time is actively working against you, and it's this silent cost that you absolutely must be aware of.
All right, let's rapidly recap what we've mastered today just to make sure you are feeling fully confident. Number 1, premium is simply the option price. 2, it's the actual money you pay to buy the option and secure your rights. 3, that premium constantly changes with market movement, just like a stock. And finally, number 4, to find your actual out-of-pocket expense, your total cost is always the premium multiplied by the lot size.
Before we wrap, I actually want to leave you with a super quick, practical homework assignment. Sometime today, just open up an option chain on your trading platform and just observe the different premiums. Watch how they flicker and change in real time. Don't buy anything yet, just watch. This screen of flickering numbers, that's literally the beating heart of options trading, and understanding it is your absolute first real step toward mastering the market. But I want you to think about something before our next session. If time is always ticking away on these contracts, is it actually possible to make that ticking clock work for you instead of against you? Ponder that for a bit, and absolutely do not miss day 9, where we're going to reveal the answer. See you there.